The rental vacancy rate in Metro Vancouver is sitting under 2% right now, which means if you're looking for an apartment to rent, you are competing really hard against a lot of other people for not much availability. And at the same time, I want you to hold both of these facts in your head at once. There are 12,628 properties currently listed for sale on the MLS in Metro Vancouver. Just sitting there, 12,628 homes that somebody wants to sell and almost nobody is buying. January 31st, 2026. That's the reference date. The number comes directly from the Greater Vancouver Realtors official monthly statistics package released on February 3rd, and sales in the same month, 1/17. I'm going to spend most of this video on the mechanics, the actual cash flow math, the geographic breakdown that most people get completely wrong, and one specific financial risk hiding inside these towers that I don't think any other channel has covered properly. It involves a number that stopped me cold when I first ran it. I'll get there. But let that ratio exist in your head for a second. Not because I want to be dramatic about it, but because the math is the foundation of everything else in this video. 12,628 properties available. 1,117 sold. That is a sales-to-active ratio of 9.1%. In a balanced real estate market, one where buyers and sellers have roughly equal negotiating power, that ratio typically sits between 12 and 22%. We are at 9.1. We are not nudging the edge of a buyer's market. We are comfortably structurally inside one, which translates to 11.4 months of inventory across all property types in Metro Vancouver. If no new listings came to market starting today at the current pace of sales, it would take 11 to 12 months to clear everything that's currently available. For detached homes specifically, 14.9 months, nearly 15. A balanced market is 4 to 6. Actually, let me say that more concretely. If you listed each detached home in Metro Vancouver today and nothing about demand changed, the absorption math says you are statistically looking at over a year to find a buyer. Not worst case, that's what the current numbers imply. And the 10-year average for active listings in this market, 9,153. We're at 12,628. That's 38% above the long-term normal. Not a little elevated, structurally elevated. Now, February 2026. Data isn't fully in, but early reports from BODE confirm inventory jumped another 41% month over month from January. 41% in 1 month. I'll come back to what that acceleration means. But first, I want to work through why 12,628 homes are listed in the first place. Because the explanation is more mechanical than most coverage suggests, and the mechanics matter. Let's talk about the landlord side of this because a meaningful share of those 12,628 listings are investment properties, condos, apartments, attached homes that were purchased with the expectation of positive cash flow or at least a manageable monthly position. And what's happened to that math over the last 2 years is honestly pretty brutal. Take the most common scenario in the research data. A 2-bedroom condo in Burnaby, purchase price around $1.2 to $2 million. I know. Burnaby, not downtown. Not a view of the mountains. Burnaby. Just let that number exist for a moment because it's actually important context for what the investment math looked like going in. 20% down. So, you're carrying a mortgage of $960,000. If you locked in at 1.99% in 2021, which was the kind of rate people were actually getting, your monthly principal and interest payment was around $4,600. Rental income on a 2-bedroom in Burnaby was running around $3,200 to $3,400. Add to strata fees, property tax, insurance, maintenance. Your total monthly costs were somewhere around $6,500 to $6,800. And your rental income was covering a significant chunk of it. Not quite break even, but manageable. And with prices rising, the equity appreciation was doing a lot of the heavy lifting. The investment logic held. Then renewal day arrives. At current variable rates, around 5.19%. That same $960,000 mortgage has a monthly payment of approximately $5,800. That's an increase of roughly $1,200 a month. And it doesn't phase in gradually. It hits on the day you sign the renewal. Meanwhile, the rental income, the BC rent cap, limits annual increases to 3.5% in 2026. So, if you had a tenant at $3,200 a month, you can raise it to $3,312 next year. The mortgage payment went up $1,200. The rent went up $112. These are not the same sport. They're not even the same category of sport. Add strata fees. Newer towers are running $950 to $1,100 a month now. Property tax around $300. Insurance $150. Basic maintenance $200. And the BC empty homes and vacancy taxes on a $1.2 million unit. These can add thousands per year if the unit is vacant or falls under the applicable conditions. There's a version of this where you're paying what amounts to a $2,000 plus monthly penalty for the crime of owning a property that's sitting empty, which I understand the policy intent. But as a cash flow item, it doesn't help. The research documents present the total monthly carrying cost across these scenarios in a range. At minimum, for owners who renewed recently and are renting the unit out, the net monthly loss runs somewhere between $1,500 and $2,200 every month. For owners in the full cost scenario, FYO newer renewal, full expense load, current market rent, the number stretches up to $5,400 per month negative. I want to be honest about that range because different calculations in the research use slightly different assumptions. What's not in dispute is the direction and the magnitude. The cash flow that looked functional in 2021 has inverted. Owners aren't bleeding a little. They're bleeding significantly month after month while holding an asset that in many cases is also worth less than what they paid for it. That last part is the trap. You might think, okay, it's painful, but I'll sell and take my money out. Except the apartment benchmark price in Metro Vancouver is down 10.15% year over year as of January 2026. A property you bought for $1 million in 2022 might appraise today at $900,000. Your outstanding mortgage is still $800,000. After closing costs, typically 5% on a sale, you walk away with less than what the math on paper says. And if you try to refinance instead, the bank stress tests you at 6.5%. Most renewal investors don't qualify, so you can't sell without a loss. You can't refinance your way to a better rate. And you can't hold without bleeding money every month. That's not a tough choice. That's no good choice. This is what the research calls the trap. And it's why so many of those 12,628 listings are sitting on the market for months, with repeated price reductions going nowhere. I was scrolling through listings a few weeks ago. I do this pretty regularly just to track what's actually happening on the ground, and I came across a 2-bedroom in town that had been relisted 3 times since June. The price had dropped about $60,000 between the first and most recent listing. Whoever owns that unit has been paying carrying costs for at least 7 months. They've also accepted a $60,000 reduction in their ask. And as of the last time I checked, it was still sitting there. That is not an anecdote about a bad investment decision. That is a picture of what this math does to people in real time. The Housing Survivor Guide is linked in the description. Free, no email required. 7 mistakes that quietly erode property value. If anything in this cash flow section resonated with your situation, it's worth reading before you make any decisions. Here's the part that I genuinely don't think most housing content covers properly. Where are these listings actually concentrated? Because the obvious assumption, the one I made when I first started looking at this, is that we're talking about downtown, luxury condos, penthouses. Nobody wants some developers sitting on $4 million suites while regular people can't afford rent. That is not what the data shows. 71% of the distressed and unsold inventory across Metro Vancouver is in suburban municipalities. Burnaby accounts for 35% of the empty and unsold condo overhang. Over 4,000 units clustered around Metrotown and Brentwood Station. Quitlam is 22%, mostly around Lougheed Town Centre. Surrey 14%. Richmond around 12%. North Vancouver another 8%. Downtown Vancouver proper, the actual urban core, is roughly 9% of the problem. 275 units out of more than 3,000. Let me restate that because I think it matters. The place where housing is supposedly always in demand, where people supposedly always want to live, where the luxury narrative lives downtown, is 9% of this inventory crisis. The crisis is in Burnaby, in Quitlam, in Surrey, in the exact suburbs that were supposed to be the safe transit-oriented practical choice. Brentwood Station, Metrotown. These were marketed as investments backed by infrastructure, by the Sky Train. The logic said, safe, growing, equity building. More than 4,400 listings in Burnaby alone are currently sitting on the market. And here's why that distinction matters beyond geography. A luxury downtown problem absorbs differently than a middle-class suburban problem. The buyers who purchase $4 million penthouses and the buyers who purchase $900,000 condos in Burnaby are not the same people. They don't respond to the same incentives, and they don't have the same ability to absorb losses or wait out a market downturn. When the inventory overhang is concentrated in the middle of the market, in mid-rise towers built for regular investors and first-time buyers, the consequences of a slow clearing process are much more widely distributed. Now, I want to do something here that I think is important for this kind of analysis because there is a real counter-argument to the picture I've been building, and it deserves an honest presentation, not a straw man version of it. I spoke recently with someone who has been buying property in Vancouver for about 15 years and is currently holding 3 condos. He's not in panic mode. He's not listing anything. And his logic isn't unreasonable. He said Vancouver doesn't build enough. It never has. The structural supply constraint is real and persistent. Population may be adjusting in the short term, but this is one of the most desirable cities on the continent. Land is finite. Geography constrains development, and that doesn't change, and rates will come down. Maybe not to 2%, but meaningfully below where we are now. When they do, the buyers who have been sitting on the sidelines, and there are a lot of them, people who qualified at lower rates and are genuinely waiting, come back. He believes 2027 looks quite different from today. And look, I get why that argument is compelling. The structural supply argument is grounded in real history. The rate sensitivity argument cuts both ways. What pushed buyers out can bring them back. Desirability is not made up. Here's the problem. When you run the absorption numbers, inventory is currently 38% above the 10-year average. The sales-to-active ratio of 9.1% is not a number that responds quickly to incremental rate changes. A 50 basis point cut from the Bank of Canada changes the monthly payment on a $960,000 mortgage by roughly $250. That helps. It doesn't transform the carrying cost math from deeply negative to viable. And there's a specific structural piece that I think his scenario underweights. The pre-sale investor market, the engine that funds new construction before a single shovel goes in the ground, because developers need 70% pre-sale thresholds to access bank construction financing. That market has essentially seized. Investor participation in pre-sales was around 50% in 2021. It dropped below 20%. And in pre-sales specifically, based on the most recent data available, it's now at approximately 7%. 7%. The entire construction financing model was built on investors hitting that threshold. At 7%, there's no model. The pipeline of future supply isn't slowing, it's freezing. So, my colleague holding 3 condos might be right about 2027. The math just doesn't show a smooth path to get there from here. Okay, this is the one I've been waiting to get to. Not because it's the biggest number in the story, but because it's the one that almost nobody running the monthly cash flow math includes in their calculations. I didn't the first time I worked through this data. It's called a strata special levy. Every condo building has a reserve fund. Monthly strata fees contribute to it over time, and it sits there to cover major repairs, elevator work, roof replacement, waterproofing, structural maintenance. It's a sound system when it works. The problem is, it requires consistent contribution from all unit owners. Now, what happens when a significant portion of a building is vacant or developer-owned, or units are caught in some kind of default process? Let me say that more precisely because it matters exactly how this happens. The developer finishes the building. Some units sell, many don't. The developer still technically owns 30 or 40% of the floors. And in some of these situations, this is documented, not hypothetical. The strata fee contributions from those developer-owned units are not being made at the rate the reserve fund needs. Meanwhile, the building ages, maintenance comes due. Buildings always have maintenance. Elevators don't care what interest rates are doing. Take a standard 200-unit tower. Total replacement cost around $80 million. Reserve fund should sit at roughly 20% of that, $16 million. Annual strata budget around $2.4 million, which is about $1,000 per unit per month. If 30 to 40% of units stop contributing properly, the fund develops a shortfall. And when the building needs work, not if, when, the remaining contributing owners pay for the gap. In a scenario where 30 to 40% of a tower has stopped contributing to the reserve, which the research identifies as a real condition in specific Burnaby and Coquitlam buildings right now, that special levy assessment can reach approximately $60,000 per unit. When I first ran this through, I had to go back and recheck the source. Not because I didn't believe the math. The math is straightforward, but because of where it lands in the context of everything else. The owner of a Burnaby condo, who is already negative $1,500 to $2,200 every month, who bought something now worth less than they paid, who can't refinance and can't sell without locking in a loss. That same person now potentially faces a $60,000 special assessment, which is not optional, which cannot be declined, and which shows up on a specific timeline regardless of their financial position on top of everything else. And the feedback loop from there is purely mechanical. When the levy is issued, some owners can't pay. Their unit goes into the delinquent pile. The levy gets recalculated across fewer remaining contributors. Per unit cost goes up. more owners can't pay. More defaults. Property managers across the Lower Mainland have documented this pattern. It's not theoretical. It's what happens when reserve fund contributions fall below a critical threshold. 71% of the listings in this market are in suburban mid-market towers, not luxury properties held by investors with deep capital reserves. Mid-market towers in Burnaby and Quitlam, owned by people who made a standard investment decision in a heated market, and are now working through a month-by-month calculation of how long they can hold on. A $60,000 surprise assessment on top of a $1,500 to $2,200 monthly loss. That's the kind of number that turns "I'll try to wait it out" into something else entirely. Strategic default is the polite term. You hand back the keys, you take 7 years of damaged credit, and you lose the property. This is the risk that doesn't show up in price indexes. 12,628 listings is a statistic. The strata special levy cascade is a mechanism, and it compounds everything else. If you own a condo in a building with high vacancy or a large share of unsold developer units, you have a right to see the reserve fund status. It's public information through your strata council before any other decision. That number deserves your attention. The Housing Survivor Guide in the description covers exactly this type of structural risk. The stuff that doesn't make headlines until it's too late. Free, no email link below. And the strata levy thing, that's the individual owner picture. But none of this stays contained there. Renee Intelligence's Q2 2025 research identified 3,590 empty and unsold condo units across Metro Vancouver. Completed buildings, finished units, ready to move into sitting empty. Those units have construction loans behind them, typically sized at 70% loan-to-value. If 20 to 25% of those loans become non-performing, meaning the developer can't service the debt, the potential write-down for Canadian banks on Vancouver condo exposure lands somewhere between $500 million and approaching $1 billion. I want to be precise about what that means. The major Canadian banks are well capitalized. C1 capital ratios, the core equity buffer that regulators watch, are sitting around 13.5%, well above the O regulatory minimum of 11%. Even a worst-case write-down on Vancouver condo exposure does not threaten a bank's solvency. Nobody is going bankrupt over this. What it does is create real pressure on bank equity valuations. And for anyone holding Canadian bank shares in a retirement portfolio, which is a very large number of Canadians because these have historically been treated as the boring, reliable part of the portfolio, this is now a variable that wasn't there a year ago. Bank provisions rose roughly 25% in Q4 2025 on renewal-related risk, which means if your investment thesis was, "I don't need to think about the banks," you probably do now. Not a catastrophe, a variable. That's not panic, but it's not nothing. And it doesn't simplify that roughly 60% of all outstanding Canadian mortgages are coming up for renewal in 2025 and 2026, many of them locked in at under 2%. The banking system is absorbing developer loan stress, a nationwide mortgage renewal shock, and softening collateral valuations, all simultaneously. Each one is manageable in isolation. The overlap is what deserves attention. When you aggregate the cash flow stress across all 12,628 listings, and I want to be clear that this is a calculated estimate based on the inventory data, not an externally verified figure, so treat it as directional. The analysis suggests the Metro Vancouver market is burning through approximately $6.5 billion in negative cash flow annually across all those properties, all those negative monthly positions. That's the scale of the capital drain on local purchasing power. Not precise to the dollar, but the order of magnitude is real, and it's not small. I have a colleague who does commercial construction project coordination. We talked last month, and he mentioned 2 projects he'd been expecting to move forward in early 2026. Both got shelved, not canceled, shelved, which apparently is the worst outcome because it means nobody's actively working toward a decision. And for every tower that doesn't go up, you're looking at roughly 500 direct and indirect jobs over a build cycle. Construction workers, trades, suppliers, engineering firms. The estimate across BC from the current pipeline freeze is upward of 5,000 construction jobs at risk. Companies in the lower mainland that have 50 to 70% of their revenue tied to Vancouver high-rise volume. Concrete suppliers, structural steel, glass manufacturers. They feel pipeline pauses immediately. On the government revenue side, which doesn't get nearly enough attention in housing coverage, property transfer tax revenue is projected to drop roughly 60% from peak. Development levies down around 80%. Combined with reduced corporate tax from the sector, that's approaching $830 million in lost provincial revenue. The programs that support people under economic stress cost more when the economy is contracting. Less money in, more required out. It's a bad combination for any government trying to respond to the situation. So, where does this go from here? And I want to give you the honest version of this, which means being explicit about what's already in the data versus what's a projection. The January and February numbers are facts. 12,628 active listings, 9.1% sales to active ratio, 14.9 months on detached. Apartment benchmarks down 10.15% year over year, and a preliminary 41% inventory jump in February. Pre-sale investor participation at approximately 7%. Those don't require a model. They're already there. The projection layer is different. If the current absorption rate holds sales around 1,100 a month against inventory trending toward 14,000 or higher, the pricing pressure math works like this. For every month of supply above 6, property analysts typically model roughly 1.5% downward price momentum per month. At 14.9 months on detached, that's significant cumulative pressure through the rest of 2026. Unless something in the demand picture shifts, that's a model built on verified inputs, not a guarantee. I want that distinction to be clear. One more thing before the scenarios. These are stress test projections based on current trend continuation, not guarantees. The 2 variables that could change the path are meaningful Bank of Canada rate cuts or a faster-than-expected return of buyer activity. If either of those shifts materially, the math moves. I'll say that once and not keep repeating it, but I want it on the record. Look, people want a prediction. I get it. I'm not going to give you one clean answer, but I will give you something more useful. The actual range of outcomes the data supports, and what I think is most probable. The scenario I'd put highest, roughly 40% probability, is what I'd call gradual deterioration with a feedback loop. Demand stays suppressed at current levels. As inventory keeps building, some developers with unsold stock can't service their construction loans. When those units get forced sold at 20 to 30% below original ask, that resets the comparable sales data for every similar building in that suburb, which means bank lending gets tighter because the collateral isn't worth what the original appraisal said. Tighter lending means fewer qualified buyers. Fewer buyers means more inventory pressure. More inventory pressure means more forced sales. You can see where that goes. Condo prices ending 2026 down somewhere between 20 and 25% in that path. Not a crash, a correction with momentum. The more comfortable path, managed decline, rates roughly stable. Inventory clears slowly without cascades. I'd put it at about 35%, prices down around 15%. Limited receiverships, nothing that creates contagion. Painful, but contained. That's probably where most of the industry commentary sits right now. A soft landing exists. Meaningful Bank of Canada rate cuts arrive faster than expected. Sideline buyers who genuinely want to purchase come back in volume. I want this to be the outcome. I'd put it at 15%. The conditions are specific, and a severe correction, actual recession, unemployment spike, developer failures across the board is in the range. But I wouldn't lead with it. About 10% low, not zero. The fact that waits to think about, even the Federal Housing Agency's own published projections, CHC's official outlook, show a sales to new listings ratio of 32.7% nationally. A healthy market typically runs at 57. The federal agency is essentially publishing a picture that sits squarely between the managed decline and faster deterioration scenarios I just described. This isn't just one analyst's read. The institutional consensus is pointing the same direction. Here's the sentence that keeps running through my head from the Rennie Intelligence Research. Their head economist described the current condo market as, "The market is out of gas. Nothing is working." Not a journalist editorializing, someone inside the industry at one of the major real estate advisory firms in BC saying the engine has stalled. I read that quote on a Tuesday night sitting at my desk going through the report, and I genuinely sat there for a moment before moving on. Because it's one thing to see the numbers. It's another when someone with that vantage point writes a sentence like that. That's the kind of quote you file away. And now here's the part that most housing coverage skips past because it doesn't fit the market crashes, renters win narrative, the renter picture. Short-term and long-term, they point in opposite directions and both come from the same root cause. Short-term, if a meaningful share of those 12,628 listings eventually flows into the rental market because the units can't sell, that does increase supply. Rents might ease 5 to 10%. A two-bedroom moving from $3,200 to maybe $2,900 or $2,800 in some suburbs. That's real money for anyone currently renting, and it's not nothing. But the construction freeze is the other side of that math. The pre-sale pipeline that would have brought new rental supply online in 2027 and 2028 is frozen because developers can't get construction financing without hitting 70% pre-sale thresholds, and investors are at 7% participation. The cranes come down. Nothing gets built behind the current inventory. And when this surplus eventually gets absorbed, people don't stop needing housing. There's nothing waiting behind it. No new supply coming in the 2027 to 2028 window. This is the part where I think the market does something particularly annoying. It creates a window of relief for renters today and then closes it harder than before. Too much supply now, then not enough supply later. Both situations caused by the same broken investor model. It's almost elegant in how badly it works for everyone. If you're renting and you feel some breathing room in the next 6 to 12 months, it's real. But the research suggests that window is probably 18 to 24 months before the construction freeze catches up to the demand curve. Appreciate it while it's there. If you're a renter in Metro Vancouver right now, drop what you're actually paying for a two-bedroom in the comments. The official market rate is around $3,200, but I genuinely wonder how uniform that is across the different suburbs where most of this inventory sits. Would be useful data to have. Here's what I keep coming back to after going through all of this. The investment logic that made Vancouver condos look like reliable wealth building. It wasn't wrong exactly. It worked for about a decade, but it worked because of a very specific combination of conditions operating simultaneously. Prices appreciating fast enough to paper over the negative cash flow, rates low enough to make the carrying cost survivable, and a refinancing option available as a safety valve if things got tight. Remove one of those three, you're uncomfortable. Remove all three at the same time. You end up with 12,628 listings and a strata levy nobody budgeted for. Apartment prices are now down 10% year over year. The refinancing option hits a stress test wall at 6.5% that most renewal investors can't clear. Population growth, which was the engine under every demand projection, has slowed significantly and in some measures reversed. That's not one thing going wrong. That's the entire support structure for the investment thesis failing at the same time. I've been tracking this market for a few years now. I've watched different cycles. This one has a specific texture that I don't remember seeing before. Not just prices moving down, but all the exits closing simultaneously for a large number of people who made what genuinely looked like a reasonable decision in a reasonable market. That's a different kind of pressure. What the research doesn't fully answer, and I'm not going to pretend otherwise, is exactly when this resolves and through what mechanism. Something adjusts. It always does. Markets find clearing prices. Distress works through the system one way or another. The question that I genuinely don't know the answer to, and I think anyone who tells you they do is being overconfident, is whether the adjustment from here is orderly and spread over time, or whether it concentrates into something faster and harder. I said at the start that I'd come back to what the February acceleration actually means. Here it is. 41% inventory jump in 1 month. What that tells you is that the people making the decision to list, landlords running the monthly numbers, developers with carrying costs compounding, they didn't slow down in February. They accelerated. That is not the pattern of a market finding a floor. Whether that pace continues into March and April is the variable I'm watching most closely, because if it does, the soft landing scenario requires something meaningful to change on the demand side, and change fast. Run the numbers yourself. If you own property in this market or are thinking about it, your mortgage payment, your strata, your insurance, your carrying costs, compare it to what that unit would actually rent for today, and then decide what to do with the gap. Up next, Toronto in 2025. Home sales dropped to 62,433 transactions, the lowest in 25 years, while new listings surged past 186,000. Different market, some of the same pressures, and a few dynamics that are genuinely different from what we've just covered. That video is linked on screen now. The Housing Survivor Guide is in the description. Free, no email. Worth reading before the market makes the decision for you. Thanks for watching. If I missed something or got a number wrong, comments are open. See you in the next one.